Welcome to the Deep Dive. Today we're digging into the latest earnings from Nextracker Inc., ticker NXT. They're the big name in utility-scale solar trackers. This was an after-hours callback on October 23rd, 2025, and wow, the market reaction, that nearly 9% surge the next day, really spoke volumes.
It really did. I mean, that's a strong vote of confidence. It signals that investors saw more than just a good quarter. They saw a strategic shift that's actually working.
Right.
You know, the whole solar sector has been rallying, but these results and what management said on the call, it set Nextracker apart.
So that's our mission today. We need to get into the why. How are they pulling off this transition from being just a top-tier hardware supplier to becoming this integrated technology platform architect?
That's the key. It's the platform architect thesis. We're going to unpack the numbers, which were fantastic, but also dive into their record backlog and these really crucial strategic moves they're making.
Especially around M&A and their new joint ventures.
Exactly. It's not just about growing sales anymore. It's about growing margins and building a competitive moat that's, frankly, getting wider by the quarter.
Okay, let's start with the numbers then, because this was a definitive double beat. They just exceeded expectations everywhere.
On every major metric, yeah.
Top line revenue came in at $905 million. That is a remarkable 42% year-over-year growth.
And that just blew past the consensus estimates. The street was looking for something around, what, $845 million?
Also a big beat there. And that momentum, it flowed straight down to the bottom line.
It did. While the GAAP EPS was a solid 97 cents, the number everyone looks at, the non-GAAP adjusted EPS, landed at $1.19.
$1.19. And the consensus was $1.01. So they crushed that by almost 20 cents.
A huge amount of cushion there. And it confirms the quality of the sales.
Absolutely. The adjusted EBITDA hit $224 million, giving them this really robust margin of around 25%.
25%.
So for you, the listener, the immediate takeaway is this wasn't just healthy performance. It gave management the confidence to substantially raise their financial outlook for the whole fiscal year.
You know, what stands out to me there is the operating discipline. To hold a near 25% EBITDA margin when you're dealing with, well, some pretty well-publicized cost headwinds like tariffs, it's impressive.
And the balance sheet. We have to talk about the balance sheet.
It's a fortress. They're sitting on $845 million in cash, zero debt. And they just renewed a $1 billion unsecured revolving credit facility.
Which gives management immense optionality, right? They can fund growth, they can fund strategic acquisitions, all without worrying about capital or diluting shareholders.
Exactly. Okay, so that's the performance. Now let's talk about the engine for future growth, the backlog.
Right. Management confirmed a record backlog of over $5 billion.
$5 billion.
That's the definition of forward visibility.
You know, when I first started covering this space, a number like that felt like science fiction for what was a very cyclical sector.
It's just massive.
It is. That level of order book, it provides just unparalleled clarity. It reduces uncertainty, and it lets them manage project timing much more smoothly.
And they mentioned that on the call, didn't they, that the cadence is smoother this year?
They did. That's a key sign of scaling maturity. It also points to this flight to quality idea. Customers are consolidating their spending with providers they know are reliable.
And that stability, that visibility, is what gave them the confidence to raise their full-year guidance so much.
Correct. The new revenue range is now $3.275 billion to $3.475 billion.
And the adjusted EPS?
That jumped to $4.04 to $4.25. And for anyone modeling this out, they did give a little hint on timing. They expect the second half of the year to be a bit more weighted toward Q4 than Q3.
So if the core solar tracker is now the baseline, how are they capturing the rest of the project's, wallet share? This gets us right to that strategic shift.
Yes, the platform architect move.
From just a component maker to something much bigger.
It's all about the adjacent systems, the high-value electrical stuff, the structural components that all have to connect to the tracker anyway. They're using smart M&A and their own R&D to solve complexity problems for their customers.
Okay, let's get specific. Their electrical balance of system, or eBOS segment, they launched a new product, NX PowerMerge. For listeners who aren't on a utility construction site every day, what exactly is a trunk connector?
A trunk connector is basically the nervous system for a solar farm. It manages that complex web of wiring that connects thousands of panels back to the inverters. It's often where you see bottlenecks and where labor costs can really add up.
And this new product simplifies that.
It simplifies and accelerates it. And the proof is in the numbers. Management said the launch immediately led to record bookings for their eBOS solutions. In fact, this one quarter was the highest quarterly sales in the 40-year history of Bentech.
Bentech being the company they acquired to get into this space.
Right, which just shows incredible speed in cross-selling. They bought a company and immediately scaled its product across their massive 150-plus gigawatt installed base.
A perfect example of M&A integration. But it's not just electrical. They're also going after structural complexity with their first fully integrated NX Earth Trust Foundation.
Yes, and they claimed it reduces the parts count by an order of magnitude.
Why is that such a big deal for a customer?
Because time is money on a construction site. Fewer unique parts means lower logistical costs, easier inventory, and faster installation. It just eliminates layers of complexity and risk. You're creating a single, streamlined solution.
Which is what the platform architect strategy is all about.
Exactly. You're selling solutions, not just pieces.
Speaking of solutions, we have to talk about the Origami Solar acquisition. This is about advanced module frames, right? To solve what they call the floppy module problem.
That's right. Modern solar panels are getting huge, physically massive, and that size makes them structurally vulnerable, especially during installation or in extreme weather.
They can get damaged easily.
Exactly. The Origami tech uses these advanced steel frames to increase durability and, once again, reduce installation labor. And the market validated this move instantly.
How so?
They secured a multi-year deal with a major U.S. panel maker for multi-gigawatt volumes of these frames, a deal valued at over $75 million.
So that's an immediate revenue stream. But what's the long-term strategic angle here, especially with U.S. policy in mind?
This is the fascinating part. This acquisition positions them to use domestic U.S. steel, and that is key.
Because of the IRA, the Inflation Reduction Act.
Precisely. It helps their customers secure those valuable IRA tax credits, specifically the 45X manufacturing production credit. By providing a frame that is eligible for domestic content credits, Nextracker makes their entire package more cost-effective for their partners. It locks them in even further.
Okay, so a ton of innovation on the product side, but that was matched by a huge geographic move. The Nextracker Arabia joint venture with Abunayyan Holding.
A massive play. They're targeting the Middle East and North Africa, the MENA region. Saudi Arabia's Vision 2030 targets alone are just gigantic.
You need something like 20 gigawatts of solar a year.
The market is huge. But the genius here is that this isn't just a sales deal. It's a deep localization strategy.
What do you mean by that?
The JV will actually localize production and manufacturing in the region. That strengthens their supply chains there and dramatically improves their win rates in big government tenders because now they're a local partner and it's already working. They confirmed they're fulfilling multi-gigawatt orders from a factory they just stood up in Saudi Arabia.
But they kept stressing the asset-light part of this. How is the JV structured so that it is asset-light? What does that mean for their financials?
That's critical. It's a roughly 50-50 partnership, but they plan not to consolidate the JV on their own balance sheet.
Which means?
It means they maintain their high margin profile. They're basically leveraging technology licensing fees and royalties from the JV rather than absorbing all the capital costs and operational risks of running factories themselves. It's a textbook move to tap into massive demand while keeping the parent company financially lean.
Okay, let's shift to the macro context. Let's talk policy. Their guidance seems to rely on a stable regulatory environment.
Absolutely. The whole outlook assumes that permitting stays stable and that the policy around IRA incentives remains intact. Now, while the IRA is a huge tailwind, tariffs are still a headwind.
A measurable one. They quantified it, right?
They did. Management noted that Section 232 tariffs, mostly on steel and aluminum imports, cause a roughly 300 basis point impact on their margins in Q2.
300 basis points. That's a huge drag.
Yeah.
But are they managing to mitigate that effectively?
Yes. This is where their domestic supply chain comes in. They have over 25 U.S. manufacturing partners. That domestic production is what allows them to get the benefits from the 45X credits, which helps offset those tariff costs.
This brings up that age-old question for solar. What happens when the tax credits finally go away? The whole sector has a history of collapsing without subsidies. Why is management so confident this time is different?
Their confidence comes from two places. First, solar panels just keep getting more and more efficient, which constantly pushes down the cost of energy. And second, their own software tools, like TrueCapture, are adding real economic value.
So the projects just make sense on their own.
That's the argument. They pointed to a big project they did in Mexico with no tax credits at all, proving the underlying economics can stand on their own in most of the U.S. and globally, even as subsidies eventually fade.
So the story is shifting. They see themselves less as a company that just benefits from a government policy cycle.
And more as a category architect whose value is intrinsic and growing over time.
All right, it's time for the segment where we look at the financial implications, but we have to say it as always. This is not financial advice. So we've just gone through a massive beat and raise quarter, record backlog, new high-value products, cash-rich, debt-free balance sheet. What's the outrageous but plausible trade idea this all supports?
Okay, the trade pitch is what I'm calling the global platform spread bet.
Right.
The thesis is this. The market is still valuing Nextracker mostly on its core tracker business. It's underappreciating the long-term compounding growth from these new ventures, especially the asset-light, royalty-based JV model and the immediate margin help from the domestic frames business.
And you think there's a catalyst coming?
A huge one. The upcoming Capital Markets Day on November 12th. That's when management is going to provide the long-term math and margin details on all these new product lines.
So the action you're suggesting is a long-dated bull call spread and at the same time shorting a competitor. For listeners who might not be deep into options, can you quickly frame what a bull call spread is?
Sure. A bull call spread is a way to express a strong but measured bullish view. You're capping your risk and your potential profit. You're betting the stock will rise significantly, say, targeting $110 within a certain time frame. You're not betting it goes to infinity.
And why pair that with shorting a competitor?
Because you're explicitly betting on the platform moat. You're betting that Nextracker's tech advantage and their ability to capture more wallet share will cause their valuation multiple to diverge from a competitor who is less technologically integrated.
So beyond the great quarter, what makes this plausible?
It's a bet on execution and optionality, the cash on hand, the lack of debt. It means that they can fund all this growth without diluting shareholders. You're betting the MENA JV quickly turns into a high-margin licensing stream and that the domestic manufacturing push provides a defensive floor for margins through 2026. It's a bet on the architect, not just the beneficiary.
So wrapping this up, what does it all mean? Nextracker delivered a clean beat, they raised guidance substantially, and they backed it all up with real, tangible strategic moves.
Moves that increase their wallet share on every single project, from frames to eBOS to this huge joint venture in the MENA market.
And that immediate market reaction, that pop, it confirms investors believe in this integrated technology platform strategy.
They're using their acquisitions perfectly, not just for more volume, but to create these immediate high-margin revenue streams that just solidify their leadership position.
So we're watching 4 key things over the next 6 months. First, the details that come out of that Capital Markets Day on November 12th.
That's the big one. Second, the scale-up milestones for the Origami frames and the NX PowerMerge shipments. We need to see that growth continue.
Third, the execution in Saudi Arabia. We want to see that revenue flowing from the JV. And fourth, just continued stability in U.S. policy and permitting.
And of course, a crucial reminder that everything we've talked about today is based on the company's publicly available earnings information. It is not personalized financial advice.
And here's a final provocative thought for you to mull over. Given how fast customers are adopting these non-tracker products, the eBOS, the advanced frames, the foundations, how quickly will the market start to value Nextracker with a multiple that reflects its new status as an integrated technology platform? Something more like a tech licensing company, rather than just a hardware manufacturer that works with steel and aluminum.
Thank you for diving deep with us.